the market moves so much that it could take $100,000 account to zero. You can take a 200, a 300, $400,000 account to zero by you continuing to add contracts because this that one rare time the market keeps going against you. Let's talk about the dangers of adding more contracts to an option trade gone bad. Now, this is important to understand what I'm about to say because a number of you understand that we have two short-term trades. We have three short-term, right? But two of the three, we actually add more contracts to those two type of short-term trades. We have the 1DTE strategy that we call your personal life changer. That's the course that we have that we encourage you to go and get that course if you ever before you do the 1DTE trade. But we have a process, a system, a cadence that we add more contracts to that trade. We have the Print Money 7DTE course that we encourage you to get before doing the 7DTE trade, and we add contracts to that. But what is the key is that we start the trade understanding that we can potentially add more contracts, and it's a limit to it. It's a limit to the contracts we're going to add because, as you know, with the 1DT trade and the 7DT trade, we start off with 5K. We allocate 5K to the trade. And for the 1DTE trade, we start off by using 10K because we're using a 20-point wide spread if we're doing it in the SPX, right? If we're doing it in SPX. So we're not using all the capital initially. Then, as you know, if we have a problem, we're going to go from two contracts, or excuse me, one contract we start with to two contracts, which would equal the 4K. Then if we have another problem, we're going to roll out again. We go from two contracts to five contracts, but we change it to a 10-point wide spread. So that would equal the 5K. So that's our limit. That's our limit. We cannot go use more than 5K. And the reason why you have to have a limit, I'm going to explain that in a second. The reason why you have to have a limit. But you guys also know with the 7DTE trade, we start off with that same 5K, but we're only using 1K initially. And then we use an additional 1K for every contract that we add. But we end at, right, the most we can have is 5 contracts, which would equal that 5K, 10 points wide. So that's our limit for every one contract we start with. Obviously, if you start with 2 contracts, your account is bigger and your limit is 10K. If you start with 3 contracts, your limit is 15K. But it's a limit to it. It's already baked into the trade. It's already structured into the trade. You already know the cadence of how you're going to adjust the trade if something goes wrong. You know the proactive adjustments, which are offensive adjustments, and you know your defensive adjustments. You already have that in place already. But it's limits. And you have those limits because the market can do things sometime, not often, but even if it's, 1 out of 100 times, you want to make sure that doesn't destroy your account. So you have to have limits. So we can with adding contracts, you guys, if you don't have the structure correctly, adding contracts can be dangerous. Obviously, most of the time not, but sometimes, especially like this last month or so, it was super hard, right? A little over a month for let's just say the last 40 days, 45 days would have hurt you in a significant way if you just continue to add contracts thinking, okay, I'm going to move away from danger and add more contracts without having a framework around it and a limit. The market moves so much that it could take $100,000 account to zero. You can take a 200, a 300, $400,000 account to zero by you continuing to add contracts because that one rare time the market keeps going against you. You do not want to do that because you don't have the framework around it and it can wind up crushing you. Obviously, most of the time when you do that, it's going to work out. But the markets can lull you to sleep. You can think that, okay, this has worked for me the last 50 times. It's worked for me all these months in a row. This worked for me all these trades in a row. And then the market will get you because you don't have a limit. You keep adding more contracts to a bad situation. And the situation just continues to worsen. And It can happen in any trade that can go that if you continue to add contracts, but it can be, the problem can be exacerbated by with short-term trades. So the 0, the 1, the 7 that we teach here. But obviously with the 1 and 2, like, or excuse me, the 1 and the 7, like I said, we have limits to it. So then you know, okay, I'm done. I can't add any more. Can't add any more. But our 0DT trade that we teach here at the Dorian Trader, we don't teach adding more contracts. Right? The statistical day trading course that Dr. Meadows has created for us in the framework of our trade style for the 0DT trade, we don't add more contracts. But some of our members have been doing that. They've been adding more contracts to a 0DT trade, and over the last month or two, that has turned out to be disastrous because you can add more contracts and be 100 points away going into that next day, right? And the market moves a ton. You guys know we were moving 130, 125, 100 points often in that S&P 500 over the last month to a month and a half, maybe even 2 months. We had a lot of big moves. The moves were so big and so unpredictable that we stopped trading the 1DT strategy for a couple weeks. The first time we've done that in years, because the market has been so unpredictable, and the markets can do that from you. The old term Mr. Market is going to eventually beat you. And so when it does, you want to make sure that you have the framework in place that you don't destroy your account. If you're still in a trade and it's 0 DTE, then it's risk still. If you haven't closed that trade yet, you still have a lot of risk, regardless of what the delta says. This delta right here on the call side, if I was at a 3, let's say this was my trade, I was on the 3 on the call side, yeah, I would think that the odds saying I'm safe, but it's still risk there. It's still risk there. If I'm at a 3 delta on the put side, yeah, it seems like I'm really, really far away, but it's still risk there. This is not going for 0. It's not going for 0. So it's still some risk there. Yeah, the odds are on your side that it's not going to go down to the 54.60 today, but it can. It can. So you have to be more vigilant with 0 DT trades. This is why when we're doing 0 DT trades, we usually have stop losses if you're doing it in SPX. That and why Dr. Meadows has been so successful at this. One of the reasons why he's been so successful at the 0 DT trade is because of the discipline of putting the stops and letting the stops do their thing so that he doesn't have to emotionally decide should he get out of the trade at that time. And then if he adjusts a trade, which you guys know he does, and once again he teaches in the statistical day trading course, when he adjusts it, doing a roll away, doing a roll up or whatever, he's going to add new stops, always thinking about risk first. Because once again, if you're in the trade and it's 0 DTE, you still have risk. And so if the trade is going bad, let's just say you're on this side here right now. Let's just use the put side for example, and this is your trade. And let's just say you have a 20 point wide spread on. You buy this back. I'm showing it as it's buying back. And then say you decide, okay, well, I'm going to move this 15 points. And I had, just say you had, one contract on, just for example purposes. Well, if I add a contract at this point, well, now I just potentially doubled my max loss, or darn near doubled my potential max loss. Doesn't mean you're going to have that, but you doubled it. And so if the market does fall fast, now you have to adjust again. And let's just say you decided you're going to stay in the 0 DT trade. Well, let's say you try to move it again. So you buy it back and you roll it away again, and then you add more contracts again. Well, so now let's just say you went from 2 to 4. Well, okay, you increase your risk some more, and if the market keeps going against you, then let's just say you decide that you're going to move it to the next day. You're going to move it to Monday, and you're going to add some more contracts. So now the trade looks like this on Monday, and so instead of having 4 now, you have 8 because you doubled again. Right? It looks something like this. Well, you didn't have a plan of adding contracts. You don't have a stopping point now. Now you feel like you're stuck in the trade and you have to fight all you can to win this trade because now your loss is pretty substantial. So you decide, okay, well, this trade is going bad again for me. I'm going to, because let's just say now it's at the money again. And I'm just giving these as examples, you guys. Say it's at the money again. And this is the trade it looks like when you bind it back. So you move it again and you add more contracts, right? So you go from 8 to 16 because that's what you need to be able to overcome the debit you're paying. And I know some of you might say, well, I wouldn't do that. Why would I do that? I wouldn't go from 8 to 16 and I didn't have that plan originally. Well, that's not true. We do things when we fail to plan. We do things, that old adage, right? If you fail to plan, you plan to fail. So when do you stop? If you still have more capital in your account and your account is a good size, big size account, and you still got more capital in your account, when do you stop adding more contracts? It's danger when you're doing that. And the only reason we do it with the 1DT and the 7DT is because we have the framework around it and we structured it in a way, the cadence that we should be able to win 95+% of the time. But I just say 95%. Well, we still accounting for that 5%. So we're saying, okay, it's a time to say, uncle, you cannot add any more contracts. You cannot add any more risk. Doesn't mean you can't still adjust, but you don't want to add any more risk.